Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&M Consulting and Len Suzio of GeoData Vision.
Dean, I see the topic you selected for discussion today is flood. We have recorded several podcasts talking about climate risk, global warming, and changes in weather patterns. So this topic appears pretty timely to me.
Correct, Len. We've discussed many climate-related risks. However, flood events have resulted in significant losses to individuals and a renewed commitment from regulators with respect to compliance.
Oh boy, anytime I hear a quote renewed commitment from regulators, my antennae go up. Dean, please expand for our audience if you can and hold back the laughter.
Well, we'll do. Yeah, my antenna goes up too. I agree. Let me first start off by saying, flood provisions are not new. They certainly have been around for a while, though we've seen different versions of it. But they're not overly complicated. It touches in different areas in the loan process. So I think that's part of where some of the problems may exist. But strong controls are critical. If we have strong controls, adequate training, I fear violations will continue. But I think that institutions will avoid some of the civil money penalties and potential violations if they enhance those strong controls.
You would think, wouldn't you? I mean, with thousands of dollars at stake per violation, financial institutions would have processes in place to ensure compliance.
Yeah.
What do you say?
Well, yeah. I mean, I agree, and I think for the most part, I have to say, financial institutions have done a pretty good job overall. But we do continue to identify violations when we perform audit testing, and with the NFIP, lapsing and then continuously extended. Not to mention the recent amendments that provide an option for financial institutions to accept private insurance policies. We continue to see flood violations surging.
Wow. So, for our audience, Dean, can you expand on what some of the issues are that you're observing?
Yeah, that's a great question, and I certainly will. But I think it's important that I first give you that kind of 30,000-foot view of what the compliance expectations are. The statutory requirements apply when improved real estate, and that is a building or a manufactured home, mobile home, is taken as security for a loan. And when that happens, a lender has responsibilities that they must adhere to, and hence strong controls and procedures in place. So we first have to determine whether that building or manufactured home offered as security for the loan is or will be located in a special flood hazard area. And this should be done early enough in the process. There is this what they call reasonableness standard, where regulators require that you notify of the need for insurance within a reasonable period of time, which is defined as 10 days. So if you don't do the determination early enough, then you're up against it with respect to the closing and notification. Document the determination on what we call the standard flood hazard form that is provided, whether the building is in a low to moderate flood risk area and or not. It should be documented on the standard flood hazard determination form, and those are updated periodically. So we have to ensure that you're using the correct version on that determination. And then we have to provide notice to the borrower if collateral is or will be located in a special flood hazard area. There is a standardized sample notice from the special flood hazard area notifying, the applicant that they're in a special flood hazard area and the need for flood insurance. And it's a little, the regulation, or I should say not the regulation, the guidance is a little vague in this regard. But one thing that is required with notification is proof of receipt, not just proof of mailing. And we do see a lot of violations in that particular area. So there's there again, there's one requirement that we have to make sure we understand. Proof of receipt is required. It also requires that flood insurance uh, uh, be obtained in the appropriate amount, and that does require a calculation by the institution. And again, this gets a little confusing because of how they calculate flood insurance, and there are different standards, whether it's a consumer or a commercial. And I'll go into that slightly in just a moment. We also have to require escrows for flood insurance premiums if escrow is required for other items such as your hazard insurance and taxes. So typically commercial is excluded from that, but certainly on the retail side, we have that issue. During the term of a loan, we also have to ensure that flood insurance is maintained or obtained if the lender becomes aware that the building involved subsequently becomes part of a special flood hazard area. We have to make sure that you consistently reconcile those what we call tracking reports. So there's an internal tracking report, and then you have what we call life of loan monitoring, which is typically a third-party external report. And those have to be reconciled to ensure that we have all loans that should be covered accurately. And then the other thing that comes into play when I think of that particular area is that oftentimes borrowers think that they're more savvy than the particular lender. So they'll provide you with a policy that is for $1 amount. And then after the loan closes, they think, oh, well, that's no problem. I'll call the insurance company, lower the dollar amount, lower my premium. The bank will never know, and we'll be all set. So again, tracking and monitoring is very critical, because in those circumstances, we would have to require that we have to notify the borrower, and then we would have to encourage them to get in a new policy in the appropriate amount. And then last but not least, we would have to force place insurance if they don't obtained insurance in the appropriate amount. And then that has to be done. It's called the 45-day notice. And then we would have to provide force place coverage within that 46 day.
So Dean, the guidelines seem pretty straightforward. So why are there so many issues in your opinion?
Yeah, again, another great question, Len. And I think many of the issues that we've seen relate to commercial properties in contents coverage, but issues do exist with all aspects of the provision. So let me try to break it down a little bit. The contents coverage issue relates to blanket security documents and provisions that require all contents, fixtures, and as collateral. But the special flood hazard policy that comes in doesn't include contents coverage. And we often have to look at the commitment letter and from, especially in commercial lending, to see whether or not fixtures have been considered in the process. And if they have, they need to have contents coverage in place. Of course, there are some inconsistencies with the interpretation of the provisions as well, which I believe has also led to some confusion. But the bottom line is, if you take contents as collateral or have blanket provisions in your security agreement related to contents, you need to have coverage in place, and you need to do an analysis to figure out how much or try to value those contents, so we know that we have insurance in the appropriate amount. In addition, we've seen many issues with notification, as I was just talking about, for the need for coverage. The rules do require, as I indicated just a minute ago, proof of receipt, not proof of mailing. So financial institutions need to ensure that they can support compliance with these provisions. Sending notice, return receipt requested clearly documents when someone received it, regardless of when they signed the notice. And then, of course, there are other issues as well. But there's just one other thing I wanted to add here to the notification. You know, there is a standard form that we notify them of the need for flood insurance, but what institutions also have to make sure of is that they notify them of the amount of insurance that the institution is requiring. Oftentimes, you'll find a borrower goes out and obtains insurance greater than the amount that is required. Well, if you didn't tell them how much is required, then that can result in a violation, because it looks like the institution's requiring a greater amount of insurance than is technically required. So there again, you got to be kind of careful. Some of the other issues that we've seen: inadequate coverage, the concept of what we call insurable value. I think when we first got started, many institutions went out and said, okay, let's just take the appraisal, which is market value, subtract the land, and boom, here we are with the replacement cost value, and we're all good to go. Well, that's not necessarily the case. And replacement cost value is required under the consumer or retail side actual cash value on the commercial side. And then they came up with the concept of what we call insurable value, which means, okay, one way may not be sufficient. You have to go to a myriad of resources in order to make that determination of what really is the insurable value of the property. How did you document it and then notify them accordingly? Of course, notice, not including the amount of required coverage, as I just alluded to, is an issue. Zone discrepancies. So we have a determination done. All of a sudden, our policy comes in and we don't match the zone coverage. So, for example, all of a sudden I get a determination that says I'm in zone AE, and then we get a policy that comes in and says we're in zone X. Well, that is a issue because that would imply that we perhaps don't have sufficient coverage. So the zones have to match. Closing a new loan under forced place policy, that is prohibited. Matter of fact, I did an audit just the other day. And I saw that as a particular finding. That is a major finding. You cannot take a forced place of policy at the time of closing. That is inadequate for purposes of flood insurance. Not forced placing insurance on the 46th day. We've seen that raised as an issue. We notify them that we're going to force place insurance within the 45-day notice and tell them that we will force place immediately on the 46th day. If you tell somebody you're going to do that, boy, you better do it. And the regulators are onto it. So we've got to make sure that we're doing that. And then, of course, I talked about it before, which is called life of loan monitoring by our third-party provider. We have to reconcile those tracking reports. When a loan pays off, we have to notify the provider that we no longer need life of loan monitoring because we reconcile those reports and look at it to determine whether it's still needed. These are some of the primary issues that we've seen, and these issues are identified in exams. So you can expect that the regulators will get your attention, certainly, if they're identifying them with civil money penalties.
Well, I totally agree with you. This is one thing you don't want the regulators to be finding when they show up and look at your documentation. There's a lot of issues here. And again, this has serious implications for banks. So why do you think this continues to be such a problem, especially given how long provisions have been in place for mandatory purchase of flood coverage?
Yeah, I'm glad you asked that too. You know, it does often come up. I mean, to start, I believe the lack of regulation and then inconsistency amongst regulators in interpreting the guidelines has contributed to a bulk of the issues that relate to weak controls internally. Lack of training, obviously, is an issue specific to what what the job is and what is required relative to flood. Multiple people involved in the process and a lack of appropriate oversight. So again, I indicated it touches on multiple areas. You got the loan officer involved, typically the loan processor involved, typically in the process. So, all of those things from, again, the loan officer process of making the determination, calculating the appropriate amount of flood insurance, providing the notification. Those are all things that are done in the processing of that particular loan. But then, once those initial steps are complete, it flips. It goes to the back office functions such as loan servicing and compliance monitoring. If all of these things work together, compliance should be relatively straightforward. But hey, as I just indicated, if you have a flaw in any part of that process, you could have a violation, and they take them very, very serious. The regulators do.
Well, boy, Dean, this is one of those podcasts I think people are going to play back 3 times because you've covered so many things and so many important aspects of this issue. And I do want to thank you for being so thorough and informative in today's discussion. I've learned a bit myself. This is Len Suzio from Geodata Vision saying thank you for your presentation today, Dean.
Yeah, and thank you, Len. And this is Dean Stockford from M&M Consulting saying thank you for listening to today's podcast. And me kind of stuttering through it a little bit today. I just get really excited when I start talking about flood because it's something that I think is relatively straightforward and easy to comply with. We just have to make sure that we have appropriate controls in place to ensure compliance. So again, thank you for listening today. Please let us know of any additional topics you'd like to hear in the future.
Thanks for listening to the Compliance 911 Show. If you like the podcast, be sure to subscribe so you don't miss an episode. While you're at it, Please give us a like and review to help others find the show. As always, links are in the show notes, and you can always find us online at compliance911show.com. Follow M&M Consulting and GeoData Vision on LinkedIn for all the latest news and information on compliance hot topics.